In March 2025, buried in the fine print of a massive spending bill, the United States quietly authorized $500 billion in subsidies, tax credits, and incentives, targeting a very specific set of industries: electric vehicles, batteries, semiconductors, renewable energy, and advanced manufacturing. The official story was straightforward. America is investing in its future, building domestic capacity, creating jobs, and leading the green economy. But if you look at where the money is actually flowing, and more importantly, where it's coming from, a very different picture emerges. This isn't just an investment in American industry. It's a calculated bet against Europe. A $500 billion wager that European capital, companies, and economic strength can be systematically extracted and relocated to the United States. And it's working. European manufacturing giants are quietly closing plants in Germany and France and opening new ones in Georgia and Texas. Energy-intensive industries that once formed the backbone of the European economy are relocating to states with cheap natural gas and massive subsidies. Capital that should be rebuilding Europe is flowing across the Atlantic in unprecedented volumes. This isn't competition. This is financial warfare. And Europe, trapped by its own energy crisis, bureaucratic dysfunction, and political fragmentation, is losing. The United States just made a $500 billion bet that it can hollow out its closest ally to save itself. And the terrifying part? The bet is paying off. To understand what's happening, you need to understand what changed. For decades, the relationship between the United States and Europe was cooperative, if unequal. America provided military protection through NATO. Europe provided a massive consumer market for American goods and a partner in maintaining the dollar-based global financial system. There was competition, certainly, over trade deals, regulations, tech companies, but it was competition within an alliance. The assumption was that a strong Europe was good for America, and vice versa. That assumption is dead. What killed it was the perfect storm of crises that hit Europe starting in 2020. The COVID pandemic exposed the fragility of European supply chains. The energy crisis triggered by the war in Ukraine revealed Europe's catastrophic dependence on Russian natural gas. And the economic stagnation that followed, combined with rising interest rates and mounting debt, left Europe weakened in ways not seen since World War II. Meanwhile, the United States emerged from the same crises in a fundamentally different position. Yes, it had inflation and political dysfunction, but it also had something Europe didn't: energy independence. America's fracking revolution meant it was not only self-sufficient in natural gas and oil, but it had become the world's largest exporter of liquefied natural gas. And that single advantage, cheap, reliable, domestically produced energy, became the foundation for everything that followed. Here's the core of the $500 billion bet. The United States is using massive subsidies to create an irresistible gravitational pull for European industry. And the mechanism is brutally simple. Make manufacturing in America so much cheaper and more profitable than manufacturing in Europe that companies have no choice but to move. The subsidies come in multiple forms, but they all point in the same direction. Tax credits for building factories in the United States. Subsidies for producing electric vehicles, batteries, and solar panels on American soil. Grants for semiconductor fabs and advanced manufacturing plants. Loan guarantees that make financing cheaper. Regulatory fast-tracking that cuts years off project timelines. On paper, these are domestic policies. In practice, they're designed to strip Europe of its industrial base. Let's take electric vehicles as an example. One of the industries Europe believed would define its economic future. European car manufacturers like Volkswagen, BMW, and Mercedes spent billions developing EV technology. The European Union passed aggressive emission standards to force a transition away from internal combustion engines. The plan was that Europe would dominate the next generation of automotive manufacturing. But then the United States passed legislation offering massive tax credits, up to $7,500 per vehicle, for EVs manufactured in North America, with batteries made from North American materials. Suddenly, European automakers faced a choice: build EVs in Europe and sell them at a disadvantage in the American market, or build factories in America and qualify. The numbers were stark. Building an EV in Germany, with its high energy costs, expensive labor, and complex regulations, might cost $35,000. Building the same vehicle in Tennessee, with cheap natural gas, lower labor costs, and massive subsidies, might cost $25,000. That's a 30% cost advantage. So what did the companies do? They're moving. Volkswagen announced a $7 billion investment in new American factories. BMW expanded its South Carolina plant. Even smaller European manufacturers are exploring relocations or partnerships with American firms. This isn't just cars. It's batteries, which require enormous amounts of energy to produce. It's semiconductors, where the U.S. is offering over $50 billion in CHIPS Act. It's steel, aluminum, chemicals, every energy-intensive industry where Europe's high costs make it uncompetitive. The European Union sees what's happening, tried to respond. In 2023, the EU announced its own Green Deal industrial plan, promising subsidies and support for European manufacturing. But there's a problem. Europe doesn't have the money. The European Union's budget is tiny compared to the US federal government. Member states are constrained by debt rules that limit deficit spending. Germany, historically the economic engine of Europe, is in recession and politically paralyzed by coalition infighting. France is drowning in debt. Italy and Spain are in worse shape. Meanwhile, the United States, despite its $30 trillion national debt, can still borrow cheaply because the dollar is the world's reserve currency. America can print $500 billion and the world absorbs it. Europe can't. The euro, for all its ambitions, does not have the same privilege. So, Europe's response is anemic, fragmented, and years too late. And every month that passes, more cap cross the Atlantic. But the subsidies are only half of the story. The other half is energy, and this is where the bet becomes truly ruthless. Europe's energy crisis didn't happen by accident. For decades, European leaders made a series of catastrophic decisions. They shut down nuclear plants, particularly in Germany, in a misguided pursuit of green purity. They became dependent on Russian natural gas, believing that economic interdependence would prevent conflict. And they underinvested in domestic energy production, trusting global markets would always provide. When Russia invaded Ukraine in 2022 and weaponized energy exports, Europe was caught naked. Natural gas prices spiked to 10 times their normal levels. Industries that depended on cheap energy, steel mills, chemical plants, fertilizer production, were forced to shut down or dramatically curtail production. Households faced energy bills they couldn't afford. Governments had to spend hundreds of billions on subsidies to prevent mass bankruptcies and civil unrest. The United States, by contrast, barely felt the shock. American natural gas prices stayed relatively low because the U.S. produces more than it needs. In fact, the U.S. profited from Europe's crisis by exporting liquefied natural gas to Europe at premium prices. This energy disparity is the foundation of the $500 billion bet. Because no matter how much Europe subsidizes its industry, it can't compete if its energy costs are 3 or 4 times higher than America's. Consider an aluminum smelter, a facility that refines aluminum from ore. It's one of the most energy-intensive industrial processes in existence. Running a smelter in Germany, where industrial electricity prices are among the highest in the world, is now prohibitively expensive. Running the same smelter in Texas, with access to cheap natural gas and subsidized electricity, is profitable. So European aluminum producers are closing plants in Europe and opening them in America. The same pattern is playing out in chemicals, steel, glass manufacturing, any industry where energy is a significant input cost. This is industrial hollowing on a massive scale. And it's not temporary. Once a factory closes in Europe and opens in America, it doesn't come back. The jobs are gone, the tax base is gone. The expertise and supply chains gradually follow. Europe is being de-industrialized, and it's happening by choice. Not Europe's choice, but the choice of companies responding to economic incentives that the United States deliberately engineered. Now, here's where the bet gets even darker. This isn't just about industry. It's about the euro, European sovereign debt, and the financial stability of the entire European project. The European Union is a monetary union without a fiscal union. Member states share a currency, but don't share a budget or debt. This creates a fundamental fragility. When a crisis hits, strong countries like Germany don't want to bail out weak countries like Italy or Greece. And weak countries can't devalue their way out of trouble because they don't control their own currency. The Eurozone has survived multiple crises, the 2008 financial crash, the Greek debt crisis, COVID, by papering over this fundamental weakness with bailouts and central bank intervention. But each crisis has left the structure more fragile. Now, as European industry collapses and economic growth stalls, tax revenues are falling. At the same time, governments are spending enormous sums on energy subsidies, social programs, and debt service.
Deficits are rising. Debt to GDP ratios are climbing toward dangerous levels. Italy's debt is already over 140% of GDP. France is approaching 120%. Spain is over 110%. These are levels where markets start to worry about default risk. And if markets lose confidence in a country's ability to service its debt, borrowing costs spike, which makes the debt problem worse, which triggers more market fear, a classic debt spiral. If even one major Eurozone country goes into a debt crisis, the entire Euro system is at risk. And here's the critical point. As European industry moves to America, as capital flows out of Europe, and as the economy weakens, the euro itself weakens. A weaker euro makes European exports cheaper, which sounds good, but it also makes imports more expensive, which fuels inflation. And it makes euro-denominated debt less attractive to investors, which raises borrowing costs. For a continent already on the edge, this could be the push that triggers a crisis. The United States, and the $500 billion bet isn't just about attracting European industry. It's about accelerating the weakening of the euro, making the dollar even more dominant, and ensuring that when the next financial crisis hits, it's Europe that collapses, not America. This is financial warfare, disguised as industrial policy. And it's working, because Europe has no good options. So why is the United States doing this? The official narrative is economic security, rebuilding American manufacturing, reducing dependence on China, creating jobs. And there's truth to that. But the deeper truth is that the United States is in a desperate race to preserve its economic dominance in a world where that dominance is under threat from multiple directions. China is rising. The BRICS nations are building alternative financial systems. The petrodollar is weakening. American debt is unsustainable. In this context, Europe is not an ally to be protected, it's a competitor to be weakened. Better to cannibalize Europe's industrial base and consolidate it in America than to let it drift toward China or collapse into irrelevance. This is the logic of empire in decline. You sacrifice your weakest partners to preserve your core. And Europe, for all its pretensions, has become the weakest link in the Western alliance. The $500 billion bet is America's way of saying, we can't save both of us, so we're saving ourselves.
What does this mean for Europe? The trajectory is grim. If the current trends continue, Europe faces deindustrialization, economic stagnation, and potential financial crisis. The European Union, already politically fragmented, could fracture further as member states blame each other and look for national solutions. Some countries might break away from the euro, trying to regain control of their monetary policy. Others might become economic satellites of the United States, dependent on American capital and markets. A few might drift toward China, trading sovereignty for investment. The dream of a strong, independent, united Europe, a third pole in a multipolar world, is dying. And the United States is holding the pillow. For the rest of the world, the lesson is clear. Alliances are conditional. When the stakes are high enough, even the closest partners become expendable. The United States is willing to undermine Europe to preserve its own dominance. And if it will do that to Europe, imagine what it's willing to do to everyone else. The $500 billion bet against Europe is not just about money. It's about power, survival, and the willingness to sacrifice long-term partnerships for short-term advantage. It's about a global system where every nation is ultimately on its own, where trust is a luxury no one can afford, and where even allies are just competitors you haven't betrayed yet. Europe believed it was part of the West, part of a shared project of liberal democracy and economic cooperation. What it's learning now is that the West was always American dominance with European participation. And when those two things come into conflict, Europe loses. The factories are closing, the capital is leaving, the euro is weakening, and the United States, with its $500 billion in subsidies, is betting that it can absorb Europe's strength before Europe realizes what's happening. It's not a bet against Europe's survival. Europe will survive in some form. It's a bet that Europe will never again be strong enough to challenge American primacy. That it will become a continent of museums and history, economically dependent and politically irrelevant, while the real competition for the future happens between America and China. And so far, the bet is working. History doesn't repeat, but if you ignore it, it will crush you all the same. If this gave you a new perspective, hit subscribe. Follow the Capital. It never lies about who's winning.